Good afternoon, everybody, and welcome to another edition of the Hedgeye Sector Spotlight. I'm Sean Jenkins, joined by Sector Head Hesham Shebaan, who is here today to discuss a thesis refresh on TripAdvisor. As always, we'll have a sort of Q&A session at the end of Hesham's prepared remarks. So if you feel like you want to ask a question, pop them into the QA box on the website. Without further delay, Hesham.
Thank you. Thank you, everybody, for joining us. I wanted to run through essentially a thesis refresh on TripAdvisor, since a lot has happened from the time that we went long up to today. And there's a lot of moving parts there. And essentially, we're at a point right now where we're essentially in a holding pattern regarding this position, because what we were essentially playing for in the beginning of the year is not exactly what's going on today, in that we weren't signing on to what management is currently doing right now, as in a massive pivot off of what they had originally laid out earlier in the year. So we're going to start by going through just a very, very quick refresh of our original thesis. Then we're going to delve into what has happened since, and then what we think is going to happen longer term if TripAdvisor continues along this direction. And long story short, right now, we are in a holding pattern, which means we may actually wind up bowing out of this position even before this upcoming print that management had effectively sandbagged. So just a quick refresh. Josie, slide 5. So essentially, we were playing a recovery story when it came to TripAdvisor, in that Trip had waded into a business venture that was dilutive across multiple fronts, and something that they really shouldn't have been delving into to begin with. Now, while they're not completely getting rid of that product or that service or that venture, they have been de-emphasizing it, even though they can't publicly admit it. And with that, what you get is you get TripAdvisor lapping past this product rollout, which is called Instant Book, while at the same time it is de-emphasizing it. And there would have been a lot of growth in getting back to flat when it came to a monetization perspective. Now, what had really gotten us excited about this, that was actually the 2017 that we were talking about. What had really gotten us excited about this was essentially what we saw as a management getting into the fight as it relates to its real problem, which is Trivago. And what had happened is that Trivago was a super hyper aggressive competitor who was ramping up their ad spend to the point where they weren't generating any EBITDA, if not negative EBITDA, most periods. With that had allowed Trivago to lap TripAdvisor. Now, TripAdvisor had said that they expected their longer-term EBITDA margins to be in line with what they just did in a bad 2016, which, when you combine that with what they said about investing every dollar of incremental EBITDA back into marketing for 2017, suggested that they were really looking to get into the fight. Now, that being said, by doing so, you are now bringing the fight back to Trivago, and the only competitive advantage that Trivago had was this ad budget. By TripAdvisor doing it at the same time, it puts Trivago at a considerable disadvantage, because as it stands right now, which we're going to get into, Trivago has grown to the point where it represents such a massive amount of Expedia, its parent's ad budget, that if Trip started targeting Trivago's ad efficiency, it would directly hit its parent, in turn forcing its parent to put Trivago on a timeout, in turn re-rationalizing the market. Now, just to give you some quick backdrop, slide 6. So this is what happened when Trip started wading into Instant Book, which is essentially an OTA type product, similar to what Priceline and Expedia offer. As soon as it started, they experienced a very, very sudden impact to both revenue growth in their core segment, and more importantly, RPS, revenue per hotel shopper, which is effectively a measure of how well they're monetizing their existing traffic. The reason being, slide 7, is because Instant Book was dilutive any way you sliced it, because one, Trip was effectively already in the OTA business because the OTAs were effectively bidding away their entire take to TripAdvisor for those leads. So all TripAdvisor was doing was going with Instant Book, was going farther down the funnel to get basically the same take. So it basically means lower take times lower conversion equals down revenues, which is what we were seeing. However, starting late last year, we noticed that they had started to de-emphasize the product. Slide 8. Essentially, instead of highlighting this Instant Book feature, they started to move it off to the side where it can do less damage. And with that, what you get is a thesis that we came up with, which was CPC recapture, as in getting some portion of that lost revenue per hotel shopper back by getting back to the basics. Now, slide 9, just to give you some context on what we were playing for, they didn't need to get all the way back to full recapture to drive meaningful revenue growth. And by the way, these charts are somewhat dated because we want to stick with the original slide deck that we went out with. But at the time, consensus was looking for somewhere between 8 and 17% revenue growth. They could have easily done that on essentially zero hotel shopper growth. Now, when you layer on their comments around ad spend, slide 10, just 5 percentage points of hotel shopper growth paints a completely different picture. That was essentially the story that we were playing for in 2017, getting back to the basics while layering on that ad budget or that ramping ad budget. On top of that, in turn, massive revenue growth, recovery story on the way to taking out Trivago at the knees. Now, slide 11, what had got us really excited, what had extended our expected holding period past 2017 into 2018 was the fact that they had rebased their longer term EBITDA margins, where they were basically looking for EBITDA margins in the mid to high 20% range, which is what they were doing in a bad 2016. So that being said, they were already looking to get into the fight, right? And if they had just stuck with their guns, slide 12, it would have put Expedia at a considerable disadvantage. Because what happens when Trivago's ad budget is now over 20% of Expedia's ad budget is that when you start targeting that ad efficiency on Trivago's ad spend, it directly impacts the parent. So to give you some context here, if that ad budget is 20% of what Expedia is doing and that ramps up 50% with no yield, that's going to directly hit the parent. And mind you, Expedia has other kids to feed. They have to now grow away now that we're past the model transition. They have to compete directly with Priceline, which has no problem seeding on margin via ad spend to win on room nights. So ultimately, the only thing that was going to put Trivago on a timeout was its parent. And the only way to actually do that was to directly target its parent by going after the subsidiary's ad efficiency, by ramping up ad spend alongside theirs. Now, what happened? Slide 13 into 14. Well, one, Trip introduced an optical headwind, which quite frankly was just annoying in that they had talked about a TV ad campaign, which we were definitely on board with. However, they didn't fully bake it into their estimates. So they said, okay, our EBITDA is going to be flat to down, but that is not inclusive of a TV ad campaign. Now, what had happened was Trip just gave the shorts a gift, because what had happened off of that is the sell side, who are all hold rated, which is effectively sell rated, had essentially said, okay, well, we're going to downgrade the stock because we're not going to factor in this cost into our own EBITDA estimates, which is, I don't know, the cheapest short that you could possibly imagine in all of existence. I don't think there's a level of intellectual dishonesty that I've seen up until this point. But what happened is that when the sell side started doing that, the buy side piled in also, because it was a cheap short. They were going to miss on EBITDA. And that's fine. We would have dealt with that if the revenue growth was there. Now the problem was slide 15 is that they got scared and then they pivoted. So instead of saying, okay, we're going to bolt on this TV ad campaign into our EBITDA which is going to be flat to down, they said, okay, instead, EBITDA is going to be flat to down, but instead of bolting on that ad expense, they migrated, or they're financing that by essentially reallocating less efficient ad dollars into finance a TV ad campaign. Now, what had happened off of that is that despite a really good 1Q17 print, where you had 12 percentage points of revenue acceleration despite incremental pressure on FX, also 50% more growth than the street was looking for at the time, the stock was trading up post-print. And then what happened off of that is the shorts had changed the narrative from an EBITDA miss to a vacuum in demand, as in because TripAdvisor is reallocating ad spend from the more immediate performance-based marketing channels, they're now going to be pushing it to TV, which has a longer payback cycle. So now you're supposedly going to have this $75 million delta in ad spend, which is we're not going to cover in great detail, but it was an overshoot in terms of what kind of demand problem that they were going to have, because they could have funded that TV budget on their incremental EBITDA growth as it was. I'm kind of going off on a tangent here, but that stock went from post-market winner to intraday loser because of the thesis drift on the part of the shorts. Now, that being said, slide 18, or 16, I'm sorry, management basically validated that thesis, not so much because there was this demand problem, but because they, one, were pulling back at the same time, making changes to their UI, their user interface, which hampered monetization. And ultimately what we're seeing there is 522, which actually I think that got cut off on the chart. That was a JPM conference. They gapped down 10% on that alone, right? Just by calling out that 2Q was going to decelerate, which, mind you, was supposed to be on a quarter where there should have been a massive acceleration because the IB was now fully baked into their comps. So that being said, we're kind of at a point right now where, yes, like kind of the 2Q disappointments essentially on the table. We're less concerned about what we're really trying to figure out right now is that, one, is it worth hanging around, despite the fact that we essentially already paid for our ticket to sit into the 2Q print, is it worth hanging around right now to figure out if management is really, in fact, pivoting off of its 2017 objectives, which was about maximizing revenue growth. Maximizing revenue growth was never about actually maximizing revenue growth. It was about maximizing that ad spend to take the fight back to Trivago. The fact that they're pivoting at this point in the story is a major concern. Moving on to the next section, slide 17, now what, slide 18, is that they are shooting themselves in the foot by not getting into the fight. Because there is a counter to our thesis in that our thesis is that if they ramped up ad spend alongside Trivago's, they would attack their ad efficiency, in turn hindering their parent, which would effectively force them to pare back on that ad spend. Now, the converse to that, the contra to that, is if Trip doesn't. And what effectively that means is that essentially it's just going to give Trivago air cover to do whatever it wants. Because as it stands right now, if you look at these two charts here, they're effectively paying away all of their revenues in ad expense. There really isn't any EBITDA to this model. Those percentages are the net, on the first chart, are the net return off that ad spend only. That's not an operating margin. That is the return off their ad spend. They're only generating, for example, in 2016, they only generated 20% more revenue than they spent in advertising, which is, by any stretch of the imagination, like a terrible business model. Now, when you look over to the chart to the right, you can see that there is a direct correlation to the growth trajectory. We're using sales and marketing, which is a proxy for ad spend here. There's a direct correlation between the trajectory of that sales and marketing expense to that ad spend. So that ad spend's driving their entire model. Now, that being said, yes, this is a stupid business model. However, slide 19 doesn't really matter, because the only thing that matters right now is what the street cares about. And to take a step back, there isn't a management team in our space that understands the street, that knows how to carve out and generate stories better than Expedia. And what they're doing right now is they effectively know the story. They know that the only thing that the street cares about is Trivago's revenue growth. And what you can see here, so those two red boxes, those are Expedia's earnings releases. The purple line is Trivago's stock price. And the reason why you're seeing those pops off of each one of those earnings releases is because we actually get Trivago's results from Expedia, because Trivago's results are, because Trivago is a full subsidiary of Expedia. So those pops that we're seeing, those are the revenue surprises off of Trivago. Those were effectively beats on the top line for Trivago. The Expedia in each one of those, the EBITDA in each one of those periods was irrelevant. So now you have this, you have this story where the street only cares about its revenue growth and is rewarding both Trivago and its parent for driving the top line regardless of EBITDA. What that means is that they are emboldened to do whatever they want, right? The only thing that would have been able to stop this was TripAdvisor. The fact that they're not creates a much, much bigger problem. Slide 20. As it stands right now, Trivago's already lapped Trip in referral revenue, which is kind of insane that they actually allowed this to happen, but they did. Now, the thing is that if you think about it like this, if Trivago or its parent doesn't have any incentive to pull back on marketing spend, then whatever incremental revenue Trivago generates in any period effectively becomes the incremental increase in the following quarter's ad budget, and so on and so forth, until that ad budget gets so bloated that it is going to completely drown out any message that Trip is trying to deliver to the consumer. Because ultimately, yes, TripAdvisor, they have the better platform, they have the better product, they have the more encompassing products, if you will. But Trivago has already shown all of us that the strength of the platform doesn't matter when Trip's largest competitor is just jamming this message over and over and over down the consumer's throat that the best meta search product is Trivago, right? And with that, if you think about it like this, Trivago just spent more in ad spend than Trip earns in referral revenue. We're talking about 1Q17. So this is now a really scary situation, because what happens is that if this continues, eventually Trivago is going to get to a point where their marketing budget is going to be multiples of TripAdvisor's, right? So one way or another, TripAdvisor's margins are going to decline. And we had seen that earlier in the year that TripAdvisor understood this, that they were willing to put that EBITDA to work this year. Now, the fact that they're pivoting suggests that they're more concerned with pandering to near-term EBITDA expectations versus running its business for the longer term. Now, with that, we think about it like this. One way or another, Expedia's margins are going to decline. One way or another, it's going to happen, because when you have a hyper-aggressive competitor in the market that is advertising with reckless abandon, who has no mandate to actually drive toward EBITDA growth, what's going to happen is if you have one competitor who's trying to protect their margins and then another competitor that is trying to drive revenue growth, what effectively is going to happen is that the competitor who is driving towards the top line is going to become so large that they're effectively going to start eating into their competitor's revenue, as in Trivago is going to start eating into Trip's revenues unless Trip does something about it today. So one way or another, that EBITDA is going to be under pressure. Trip basically needs to decide whether they're going to put that EBITDA to work today as they'd originally set out to do in the beginning of the year, or they can sit on their hands and let Trivago eat it tomorrow. So that being said, slide 21, everything that we showed you from what we were originally playing for, that entire thesis is essentially in a holding pattern, because what we needed was for management to follow through on what they set out in the beginning of the year. So ultimately, we've kind of been quiet for a while as we've been trying to figure out what's the best way to play it. We've been going back and forth on this for I don't know how long now.
Couple weeks.
Couple weeks. And
we're talking through it now.
We're talking through it now. Yeah, we're just going to do this for you guys. So yeah, give you some insight into
the back and forth.
The back and forth, the indecision, if you will. But I mean, ultimately, what's happening here is that we really can't be in this if management is not going to commit to what they had originally set out to do, because a pivot 90 days later is largely inexcusable. You only do that if you are backpedaling, as if you are scared of something. The thing is, if you are worried about the street now, if you're worried about some near-term EBITDA expectation that some sell-side monkey who can't think past a quarter is making you live up to, then you are in fact a secular short. Because best case study, best example of a company who knows what to do is a Priceline, who doesn't give a crap what the street thinks about them. They're going to run their model the way that they want to run it, and they're going to explain to the sell side that that's how they're doing it. They're going to own it, right? The reason why Trip is where it is today is because of the pivot, right? Because if Trip had just come out and said, okay, our EBITDA is going to be down this year, not flat to down, and maybe we might do this TV ad budget. If they just said our EBITDA is going to be down, there'd be no way we'd be talking about TripAdvisor in the 30s. It was the constant back and forth. It was the lack of clear direction, the lack of decisiveness. So, yes, everything we're saying right now basically says that we should be backing out. The only reason why we haven't is because we basically have a free ticket into the 2Q print because we already ate it. Now, that doesn't mean that we're not going to bow out. In fact, if we can find further confirmation that they are pivoting and pivoting hard, as if we can see if we can see a delta, or not a delta, if we can see a major inflection in demand, if we can find that somewhere, not only is this moving into the short bench, like we just might outright short it.
Yep.
There's a way to put to it that would have. There's another way to put it that would have too many four-letter words in there, which I don't feel like really doing in this forum.
We'll save that for a private.
We'll save that for a private conversation. So why don't we end it there before I get worked up? And Josie, why don't you, or actually Sean, you got it.
We're just going to jump right into questions. For those listening, if you have any more questions, just pop them into the queue. There's already a few here. Just for the sake of time, we're going to keep it more Trip and OTA focused. So I know there's some questions. You have a lot of high flyer stocks in your in your coverage list. So people always want to ask about them. Hesham has a Twitter. You can ping him, and maybe he can get back to you on some of those. But we'll keep it focused on Trip. Well, actually, first, this is an interesting one because you did mention Priceline and their management team and their approach to things. What are your, if you had some general thoughts on Priceline? That's literally what the question is.
General thoughts on Priceline. Yeah. I think at face value, we weren't on prints on this, but that was really a reset quarter on the guide, right? So the reason why the stock sold off on the print was because they had effectively guided below what the street was expecting on room nights growth. We have a tracker that basically said that Priceline was trending towards consensus estimates, but the way that Priceline operates is they need to give themselves 2 to 4 percentage points of breathing room on that room night number into any given print. So more likely than not, this was effectively a reset quarter just to get consensus estimates down. However, there are a few other things that we're working on as it relates to 3Q, which is why we haven't actually pursued this on the long side. Because the last thing we want to do is to be in a print where they puked the guide 2 quarters in a row. Right. So we need to figure that part out first before we actually go anywhere near this.
But
longer
generally
term,
speaking,
longer term Priceline is our horse as it relates to the OTA space for a host of reasons. Too long to get into right now. But yeah, I mean they're kind of the call it the premier model within this space.
Yeah, absolutely.
That's actually also perfectly situated from, not perfectly, but better situated from environmental factors as well.
Yeah, absolutely. I couldn't agree more. I'm trying to think that. There's some like longer form questions that I want to kind of keep towards the end, so let me just bear with me here. Just wanted to hold on. People want to talk about Netflix and Pandora and Snap and Facebook.
We can take some of those.
I mean, someone just saying, why can't Snap become Facebook? I don't know if you want to do a little. You're hosting a call on Friday.
I'm hosting
right?
a call on Friday, so and we're going to talk about a lot of that on the call. So I'm gonna skip that one.
Okay.
Yeah.
All right. Then quickly on Netflix, any refresh on Netflix and ideas on that?
I think that as far as Netflix is concerned, this has kind of been a chess match in terms of us versus management and figuring out what they're doing. So effectively, the only reason why the stock is actually where it is right now is because they had effectively moved their most popular show into their seasonally weakest quarter, right, to effectively offset what we were expecting to be an actual seasonal decline in membership.
Interesting.
At least in the U.S. As far as what we're seeing right now, we do have a tracker there. The U.S. is actually looking okay. There was a little bit of a pop in U.S. From what we're seeing, at least in our tracker, in U.S. sub ads right after House of Cards was introduced in 2Q. I think the question right now is how sticky that's going to be.
Interesting.
Because if they signed up for House of Cards in 2Q, what is going to prevent them from hopping off in 3Q?
How long? I actually don't know. I don't have my own Netflix account. I just borrow it.
Yeah, which is part of
what a lot of people do, right?
Yeah, it's a lot of people do. It's effectively what is going to. It's one of the things that's going to prevent them from getting to kind of the peak penetration levels that everybody's looking at.
Yeah. That's the long-term story, right? Our addressable market is X.
Yeah,
we're underpenetrated by Y.
Right.
This is where we're going to be.
Yeah, this is where we're going to be. Online video is going to replace linear video, and so on and so forth. And because the U.S. has disappointed everybody, in terms of growth, because net ads have been declining for the better part of like 2 years. Everybody's looking to the international markets to pick up the slack now. So what moves Netflix in any given quarter is essentially what's happening on the international net ad side and the international sub guide. So that being said, we'll probably have a follow-up note on the international side right now, and I'm kind of essentially all over the place right now, but I think effectively what management did in the first quarter to essentially kind of buoy the stock was really just a Band-Aid on something that was going to happen this year, which is really just a question of when. So
if it's not on 2Q, then maybe on 3Q.
I think we might. I actually think we might see it on 3Q. I'm not committing to that because I don't have to, because we have the trackers that are going to tell us what to do.
Yeah.
But if we've been eating it on this short, largely because of management's been jumping in front of our catalyst. Then you lump in this stupid expansion into China story, which is really just a head fake. They're not even going to count it against.
Are they in China? Yeah.
They're licensing out content to Chinese distributors, and there's not even a count.
Don't they have like a Netflix version?
Yeah, exactly. They already have.
Baidu probably has some form.
Well, that's what they're doing. They're licensing it out to another online subscription on demand company, and it's not even a count against the revenue. From the way that I understand it, it's going to count as a reduction to their content costs. So that's how much of a growth driver this is. It's not even a revenue driver. It's just a reduction to content costs.
Interesting.
Awesome. That's worth 5% punch in the gut.
All right, away from Netflix. Just a general question here on traveling. Is traveling increasing? What are you seeing in the macro environment? Will summer cause a spike, or is it just mostly pre-booked? I can talk to that.
You can do this one.
Yes, traveling is definitely increasing. Just going off of like our macro teams, they have the growth accelerating call. That definitely helps travel, but at the same time, you have sort of a demographic secular sort of push into travel. People are collecting my generation and also Generation X. You're a millennial, aren't you? Technically a millennial, right? I think you're at the upper band.
Upper band.
But anyway, no, there is definitely a secular shift that will take some of the cyclicality out of the, there's cyclicality in the travel stocks because they're economically sensitive. But at the same time, there is this secular shift towards travel, collecting experiences versus collecting things. As far as the question is concerned, will summer cause a spike or is it mostly pre-booked? Leisure travel generally booked 6 months in advance. Business travel could be anywhere from like 3 weeks or less. So a lot of the stuff that OTAs deal with is, in that 3 to 6 month window. If it's international travel, then maybe it's a bit longer.
Right.
But yeah, it doesn't. A lot of summer vacations are already booked.
Right.
If that, then I guess I don't know if
Yeah, I know. I mean, I think that's kind of the question: is that the summer spike is booked in, call it the spring and the winter time.
Yeah.
Right. So effectively, what we're going to see in Priceline's and Expedia's upcoming prints is effectively what's going to tell us what's going on as it relates to soft proxy, because there's still like kind of a small percentage.
Right.
But it's kind of a soft proxy, at least what's going to be happening on the online booking space into 3Q.
Right, exactly. And then just if the person had a question based on general travel trends, I mean, our team on the gaming, lodging, and leisure side, we have a sort of bullish travel call right now, but we've been sort of bullish on the leisure travel aspect of it as it pertains to hotels. But for hotels, what's most important for them is generally business travel. There's a higher yield on the customer there, and we've actually called for sort of a resurgence of that guest finally coming back, a better mix shift and whatnot. So, but generally, we're collectively very positive on the travel environment. So, shifting back to, I think, 2 process questions, and then I'll get into the last 2 longer form questions because a few people kind of have the same question. I'll just lump it together. But one person asking here, thanks Hesham, new to your process, what is your top long and top short? I don't know.
Yeah, no top longs right now. Top short's probably Snap.
Snapchat.
Yeah, which we're going to talk about more this Friday.
Snapchat, all right. And then this is another process question. What is the year-end target for Trip? We don't do price targets.
We
don't do price targets at Hedgeye.
Yeah, especially within the internet space, just because valuation historically doesn't really hold up. I think a lot of people like to point to valuation and try to make their calls off of that. There's companies that'll be trading at a bajillion times sales, they're going to go up 50%, and there's a company that would be trading at 1 times EBITDA that'll go down 50%, right? It's all really just about sentiment and catalysts, and ultimately it's the catalyst that's going to effectively tell you where that sentiment is going to go. And when it comes to the internet space specifically, that's effectively how we're playing it. It's different across other sectors, but this is a very Momo type sector, and kind of it's all about sentiment in this space. Yeah. Netflix is the perfect example of that.
Interesting. And then actually we'll have 3 sort of longer form questions here, kind of going off what you were saying about the management team at Trip. What do you think it is that forces them to sort of be, I know we've had some internal discussions about this, but what do you think it forces them to be different than, say, a Priceline? Is it just, experience, or is it, what do you think it is?
I mean, I think that it's a tale of 2 different companies, right? Mm-hmm. So there was Trip pre-IB, pre-Instant Book, and then kind of this, call it reactive, scared post-IB management team, right? And because the stock had just gotten absolutely bludgeoned in 2016, right? And they had actually made the right steps. They had the right direction. They said, okay, I think part of the reason why was because Trivago was behind the curtain before the Expedia IPO'd it. Yeah. And that's once they saw what Trivago was doing, because all of their financials were out there, they were able to react in the right way, where they basically said, okay, we need to get into the fight.
Right.
You rebase your longer-term EBITDA margins below what you just did because you're going to put your EBITDA to work because you know what your problem is.
Yep.
What had happened though is one is the way that they approached the street. They just need to just get that onto the table right away. The second thing is that I think they're getting a lot of pressure, not only from I think they're getting a lot of pressure from their holders right now, and I think that they are trying to appease rather than run their business, right? So there is the 180-degree difference between appeasing the street and running your business. Some of my best shorts ever are street appeasers, right? Like that's who I go after because they're making bad near-term decisions that are going to affect the longer-term trajectory of the business, right? Those are the best shorts. What we're seeing out of Trip today with this pivot is a bad near-term decision that's going to impact the longer-term trajectory of the company. Much, much worse than just a bad quarter or a bad year, as in basically entrenching themselves as the number 2 player in this space while Trivago eats their lunch. So I kind of went off on a tangent there.
That's good color for a lot of people who.
Yeah, it's just I think it's just a question. It's just 2 different management teams. There was the pre-IB management team and the scared post-IB management team. And when you have Pandora is a perfect example of this. When you're too scared to follow through on what you should be doing, which is why we bowed out of Pandora, because they were saying all the right things, looked like they had their head on straight, and then they got scared. The first sign of trouble on the most recent print, the most recent print, and it was just like, okay, it's like if you're not willing to break some eggs, like we can't stick with you.
Yeah.
Anyway, that was a little bit of a tangent there. Next question.
Oh, well, that's good color for a lot of people who people were asking about Pandora and whatnot. So I'm sure it's appreciated. Okay, so if you believe you've paid your for your ticket through the 2Q print, would you add to a hypothetical position?
No, I mean that's
right
the thing.
Now?
Because
do you think it's kind of like hold it and just?
Yeah, I mean it's when I say we paid for our ticket into the 2Q print, it doesn't mean it's a buying opportunity, right? Because if when I say we paid for a ticket, it basically means that we don't have to jump off the ride quite yet, right? If we can confirm that there is any sort of inflection in demand, we can see this somewhere. We're going to get off the loan, right? We probably should have already. It's just that we had already paid for it. It doesn't mean this is a buying opportunity, right? It just means we already ate the 2Q print, right? So staying into the 2Q print isn't as much of a risk. What we have to be thinking about also is what's going to come out as it relates to 3Q, right? And more so, what are they doing right now that's going to impact 2018? Because the 2017 trade that we're playing for, 2Q was supposed to be our print, right? Now that that's effectively off the table, what we have to look at right now is to 2018. And they're making these decisions around pivoting from maximizing revenue growth via ad spend, basically maximizing ad spend, or managing to EBITDA. Managing to EBITDA means 2018 is a short.
Yeah.
Right?
Absolutely.
So,
that's 2018 is when we were going to, it's going to bear fruit.
Yeah.
Like all the ad spend. Okay, now here we go. Now we lever it up.
2018 was effectively the year when we were supposed to see Trip reclaim its meta throne, right? Which they had effectively given away to Trivago. Right. If they're managing the near-term EBITDA today, that's not going to happen. Which means we might come back in short 2018. We're not married to positions.
Yeah, no, of course not. Of course not. That's good color. And then just last one to wrap up here, kind of longer term, going off of what you were talking about. Would you buy Trivago if you're inclined to think that a lot of the longer term things that you had laid out could come to fruition and get priced in sooner
we had talked about this. Trivago might be the preferred meta right now.
And an unsustainable model becomes sustainable.
It becomes sustainable because you only need to get your ad budget at a certain threshold higher to basically permanently, squash whatever TripAdvisor's message is. Right after that, you're just collecting EBITDA.
Right.
So, I mean, it's. The other thing to consider is that it's kind of an easier game. It's like they only have to produce revenue growth.
Yeah.
Right. Like somehow Trip needs to produce both. Right, because they have EBITDA.
Right.
You know what I mean?
Yeah, exactly.
So because Trivago's never actually had any EBITDA, they don't actually have to produce any. But because Trip is just kind of just gushing with EBITDA right now, if there's any pressure there, it's like this secular damnation story.
I like that.
So it's it's a fair point. Like Trivago, as it stands right now with this pivot, Trivago's the better play. But we're not there yet because I think that we really got to sniff test the back half numbers to see if it's actually worth playing, especially what the stock is at right now.
Right. Yeah. Exactly. That's something else. So. Okay. I think we'll end it there. We sort of usually try to keep it 20 to 30, and we're running closer to 40. But that was a lot of good discussion, good color, and whatnot. But I believe they're going to have another sector spotlight next Tuesday around 2:30. Should be around the same time. So tune in for that. And thank you for joining us today. Take care.